Good morning, everybody. Thank you very much for joining this BetaShares webinar on adopting thematic investing in client portfolios. Just a couple of administration points before we begin. Firstly, please note the webinar is being recorded, so you can view it again at your leisure or share it with any colleagues. A link to the recording will be sent to you after the session. Secondly, you should see an option on the right of your screen to ask questions. Please feel free to type any questions here and we'll either deal with them as the session is running or we'll answer them at the end for you. We'll aim to talk for around 40 minutes and there'll be plenty of time for questions at the end. Okay, just some important information before we get into. Please note this presentation is general information and is for advisors only. And as such, please do not share the presentation with retail investors. Right, I'd like to introduce today's speakers. Hopefully, most of you know me. My name's Thom Bentley, and I joined BetaShares in May last year as Director of Advisor and Institutional Business in New Zealand. BetaShares is the only non-New Zealand ETF issuer with an office here, demonstrating our commitment to the New Zealand market. With me today is Gleeson. Cam's a Senior Investment Specialist at BetaShares, and before joining us, he was a Portfolio Manager at Macquarie Asset Management, responsible for the structuring and management of Macquarie's listed and unlisted structured products. And prior to that, Cam was Head of Product at Bell Potter Capital and also worked on JP Morgan's equity derivatives desk. Just a little bit about BetaShares for those of you who are unfamiliar with us. BetaShares was founded in 2009 and now manages around $23 billion across 71 ETFs. This is the most comprehensive range of ETFs available in Australia. The team's now over 90 strong, with offices in Sydney, Melbourne, Brisbane, Perth and Auckland. Our key objective really is to provide investors with intelligent solutions to help them meet their objectives. What does that mean? In a nutshell, we aim to improve on existing index methodologies or create new indexes that we believe give investors more efficient exposure to markets, asset classes, sectors, and themes. Okay, what are we going to cover this morning? Well, firstly, why do we believe thematic investing is an important part of your toolkit as an advisor? How is thematic investing different and what does it add to portfolios? How to use thematic funds in a portfolio construction context. And finally, we'll take a look at some of our recently launched and forthcoming thematic ETFs. Okay, so firstly, why thematic investing? We believe thematic investing is attractive because it provides long-term exposure to powerful and persistent themes that are transforming the planet and our daily lives. So if we look at some of the key advantages of thematic investing on the next slide. Thanks, Cam. We believe incorporating thematic investing into portfolio construction offers a number of key advantages. Firstly, thematic investing provides access to long-term, above-market growth opportunities. Thematic funds aim to identify secular themes with long-term tailwinds, whether these are demographic, technology-led, or linked to, for example, carbon reduction. Secondly, given this outperformance potential, we see thematic funds as an alternative to high-cost active managers. Thematic ETFs provide more choice and control as to which structural growth opportunities you want to include in client portfolios. Replacing an active manager with a low-cost passive or smart beta strategy can have a profound impact on overall long-term return outcomes for clients. Whilst the future always remains uncertain, the one area where you can control outcomes for clients is to reduce costs. As Cam will touch on in more detail, businesses with structural growth drivers tend to be less sensitive to the broader business and economic cycle. And this can be particularly advantageous when economic conditions deteriorate. For example, the COVID crisis over the last few years is a great example of this. Investing in themes allows investors to access sectors which might traditionally be underrepresented within core holdings. And this is certainly something New Zealand investors can identify with, as the core of the New Zealand market is dominated by healthcare and utility-like companies. And the market has almost no exposure to technology, high-tech industrial or consumer discretionary sectors. Investing in thematic funds can lead to better diversified portfolios overall for New Zealand investors. And finally, from an advice point of view, we believe having high quality options to take to clients which resonate with their own personal interests may represent an opportunity for you to build deeper engagement with clients, as well as achieving optimal outcomes. We see from the uptake of thematic investing in self-directed retail platforms that as clients connect to specific themes like carbon reduction, thematic funds are increasingly becoming a key part of their thinking. So let's have a look at the growth story behind thematic investing. You can really see from the chart here that demand has been very strong for thematic investing, and it's actually growing. This is a chart from Morningstar, and it shows the total assets under management in thematic funds globally. This is both passive and active. And you can see that the uptake's been particularly strong, especially over the last few years. Morningstar found that thematic investing is the fastest growing segment of the market over the last year, and this is showing no signs of slowing down. Clearly, all regions have experienced net inflows over the last 3 years, but Europe and the US have been the main beneficiaries here, netting around 140 billion and 87 billion in net new flows over the period, respectively. In the US, around 63% of thematic fund assets are passively managed. And this really reflects the success of thematic ETFs in the US. Given Australia and New Zealand tend to take a lead from the US in terms of progression of ETF uptake, we believe that the next few years will see a large growth in thematic assets under management in Australia and New Zealand, well up from the 6 billion in the market today. Okay, hopefully that sets the scene and explains why we think thematic investing is going to be an important component of client portfolios. I'll now hand over to Cam to dig deeper into how thematic investing is different and how you can use thematic ETFs in client portfolios. Thanks, Cam.
Thank you, Tom. Yeah, so just before we dive into specific thematic opportunities, we want to touch on those structural forces, and Tom did mention them in passing, but we see the key structural forces or megatrends, if you like, that are really creating these thematic opportunities as technological innovation, climate change, and demographics. It's very broad forces. They're creating permanent shifts in the way that we interact with each other and our environment. They're playing out over very long-term time horizons.
Cam, I'm not sure how everybody else is feeling, but I can't actually hear you, sorry.
Can anybody, Lauren, can you hear me? Am I coming through okay?
Yes, I can hear you fine. So I'm not sure how many other people are experiencing an issue, but I can hear you.
Okay, I'll continue on, and Lauren, if you can just let Tom know when we've handed over, or we'll see if we can sort out the audio issues there. We'll keep going then. Right. So look, yeah, as I said, look, these mega trends are very broad in nature, but they create specific investment opportunities. And those opportunities can often fall out of a single mega trend, or they can fall out of a combination of these mega trends. Often where we see some of the strongest opportunities in thematic investing is the intersection of these megatrends. So where, for example, we see that a particular theme is leveraging both technological innovation and climate change. If you think about electric vehicles, we know that technological innovation is creating the means, but the incentive is created by climate change. Technology, is probably the most far-reaching in terms of creating new thematic opportunities. Technology can upend industries overnight, create new wealth, but also sometimes will result in a degree of resistance from incumbents due to the speed of change of technology. And this is where we see that climate change and demographics, which are very different in their nature, in that they're typically very slow moving, relatively predictable, can create more of an incentive or a driver. So where we see multiple megatrends combining together, we get that strong incentive base, and that can really sort of make something quite attractive to look at. What I would say overall is that if we think about these opportunities, I would consider them growth as a style of growth investing. And I wanted to look at thematic investing and really, I guess, contrast that to a traditional approach of the way people look at investing. Typically, when we used to think about investing, we'd look at the economic cycle and we'd try to predict how that cycle was going to play out in the future and look to historical patterns of behavior with economic variables and particular sectors of the economy to determine the best way to profit from that economic cycle. We call that cyclical investing. You're usually using very established industries, established stocks or GICS sector codes to invest. So just to give a couple of examples here, I've shown a couple of the ticker codes for BetaShares ETFs. If we think about an economy that we may believe might be entering in a recessionary period, traditionally healthcare, global healthcare has been seen as a defensive sector of the equity market. So you might be looking to invest in healthcare stocks during a recession. Then as the early stages of recovery start to appear, we see typically the yield curves steepen and global banks might be the right place to play. Then a little bit later in that economic cycle, we tend to see commodities and oil prices start to accelerate. And at that part of the cycle, it might make sense to invest in global energy stocks or our global energy companies ETF. So this is a way of thinking about historical patterns and how you might play the economic cycle. Looking at thematic investing, it's a different paradigm. We're looking at structural change. We're looking through that economic cycle, or almost in effect ignoring that cycle. We take a very unconstrained approach, both geographically or by traditional sectors. And we're looking for businesses which can benefit from revenue, which is less influenced by that business cycle because it's leveraging that structural change. It also critically means, as an advisor or as an investor, is that timing of the investment becomes less critical because the time frame is far longer, often multiple decades, rather than needing to enter and exit a position at a particular point in the cycle. We can afford to I guess, play the long game. So as I mentioned before, structural investing or thematic investing is unquestionably growth style investing. Here's a really sort of good example just from two stocks. This shows the quarterly revenue from both Microsoft and ExxonMobil. And so Microsoft is in orange, and there is some seasonality in Microsoft's earnings on the quarter by quarter basis, but clearly overall that is a very smooth compounding rate of growth in their revenue over time. The revenue last year grew at about 18%. It's forecast to grow at about 18% this year. Just a very clean compounding rate of growth within that company. Exxon's revenue is obviously very cyclical, and we all know the difference here. Microsoft has a business which is participating in these new markets like enterprise, like cloud and gaming, whereas ExxonMobil's industry is effectively reached maturity. So its revenue is being driven by, firstly, the overall size of the economy and the requirement for oil to fuel economic growth, but secondly, geopolitical events. And that revenue growth is far less predictable. So for example, sort of down substantially through 2020, last year up 60%. Earlier this year, before the Ukraine crisis, the revenue is expected to grow by 10%, but now because of Ukraine will grow by a figure much higher than that. So much less predictable, but also certainly less compounding in that growth. Now, I do want to make sure that we're not being too tone deaf here as to the market environment, and we have seen that growth exposures have sold off from about November of last year through the early part of 2022. But I think it's important to look at what the reason for that sell-off is, because thematic investing is about growth investing. When we look at stock price returns, we can decompose those returns into two factors. And this is typically how an economist, like our chief economist, Dave Bassanese, will look at stock price. you look at the change in earnings and change in valuation multiples. Now, what happened at the early part of this year to thematic invest or to growth stocks wasn't a collapse in the earnings prospects, wasn't a collapse in earnings growth. It was a change in the perception as to the degree of risk or the valuation multiples that should be ascribed to these companies. And the reason for that, as we all know, was as a result of increasing bond yields. So how much is the market prepared to pay for a high growth company? When bond yields go up, then it is likely that the valuation multiple will need to fall. So if you look at the underlying earnings of these companies, by and large, across almost all the themes that we have, there was very little change to the earnings and revenue profiles as an aggregate. There's always going to be isolated, exceptions to that rule. But by and large, when I look at the overall indices, they were very resilient, and they still have been very resilient in terms of their long-term earnings growth. Now, where this is interesting is that these two variables in terms of how they drive stock price returns play out over different time frames. And this can in fact influence how you should think about investing in themes based on your own time frame. And so I show here two pie charts, and this was really some work we did looking at S&P 500 index returns since 1990 up to 2021 to look at how changes in valuation multiples and changes in earnings growth contributed to the overall stock price returns. When we looked over very short time horizons, as represented by the pie chart on the left, we found that earnings growth and valuation multiple changes were roughly equivalent in terms of their contribution to stock price returns. But as we extend the investment time horizon, so if we move from looking at over a 1 year period to 5 years, 10 years, and even 31 years, we find that earnings growth becomes the dominant driver of returns, of investment returns. And the reason for this is actually kind of intuitive. Earnings growth tends to compound over time, whereas valuation multiples are arguably mean reverting. They're made up of both market sentiment, which is mean reverting, and also discount rates, which are also typically mean or arguably mean reverting. And so what this means is, and our view is that when you're looking to invest in themes, you should be looking at this as a long time horizon. We don't think of thematic investing as something you want to trade in and out of. And so if your time horizon is long term, the critical factor for you to consider, for you to get comfortable with, is having a high level of conviction as to the thematic revenue and earnings growth of these companies. Because over the long run, that will become the dominant driver of your investment returns, regardless as to what might happen over a month or two. So, thinking about portfolio construction, we offer, I think, as Thom mentioned earlier, we offer a range of funds. We've got 71 funds in total. And the core of our business really is centered around that core of your portfolio. And we're going to be looking to come to New Zealand later in a month to have a discussion about portfolio construction around the core. So look out for that. But our view is that when you're looking to build a portfolio, that core should be based around low cost, broad market beta, plus smart beta or factor exposures, where you can access that low cost exposure using those forms that will complement low cost beta. So keep your cost low, diversify as much as you can within that core. But then where we've seen people look to use thematic investing is as satellites to add potential alpha. And we've seen investors, particularly in the high net wealth space, use thematics as satellites, replacing high cost active managers and particularly single stock positions. And we see that this is increasingly the trend across our various markets that we service. Now, I show here an example of 3 of our satellites, just their ticker codes: DRIV, electric vehicles; ERTH, decarbonisation; and HACK, which is cybersecurity. Just an example, not necessarily a recommendation. But one thing that's really interesting about these themes is they typically, in isolation, because they have that theme-specific risk, they tend to be higher volatility than your broad core portfolio holdings. So that's sort of interesting because you're adding potentially more volatility to your portfolio. But because that theme-specific risk is usually quite unique, if you add these positions and if you size them appropriately, you can actually really, assist yourself in terms of creating, a strong risk-adjusted return profile, because they tend to move in directions which are a little bit less correlated with that core portfolio. So just an interesting way of thinking about adding out performance, but also not detrimentally impacting the risk profile of your portfolio. And so I'll go into an example of that later in the presentation. I did want to touch on how we look at building thematic exposures. And I sit on the product development committee, and we look at across our range of products, we look at a lot of these thematic opportunities. There are some key characteristics that I just wanted to talk to you about as to what we see as critical before we'll consider putting together a thematic ETF. Firstly, longevity. We want to ensure that people are interested in investing in this theme for not just a year or two. This needs to be ideally a multi-decade theme. We looked at a lot of potential thematic ideas that were floated around during COVID, and we were deliberately quite slow in deciding to bring particular themes to market over that COVID period because of the degree of I guess fashionableness around certain themes that were being floated. So for us, really important to have conviction on the longevity. Secondly, we need to ensure that the investable universe is I guess mature enough. Are there companies that are appropriately exposed to that theme, such that if that theme does take off, the fortunes of those companies will actually improve? And are those companies liquid, tradable? Can we create a diversified exposure to that portfolio? There's plenty of opportunities I can point to where we've either delayed a launch until we thought that universe is ready, or where we've just decided to not participate in that particular theme because it wasn't appropriate. And then finally, we've got to have conviction that those companies are going to be able to monetize. They have a competitive advantage. There's something there where you're going to see that outsized profit. Once we've identified an attractive theme, our view is the best way to play thematic investing is through a passive rules-based approach. We focus on pure play companies, and we look to diversify the risk that you're taking across those stocks to reduce to the greatest degree possible stock-specific risk, because you want exposure to the theme as a whole, not to individual stocks. The failure rate in growth investing in embryonic industries can be higher, and so it's about taking a exposure to the theme as a whole. And we'll talk on the next page about the winner takes all dynamic, but why we think this is the right approach. The winner takes all dynamic, you can look at some research by Bess and Binder and some others around stock price returns and dynamics there. At university, we typically taught that investment returns are normally distributed, the bell curve that you might remember. And that's true certainly for index returns or short-term returns like daily returns. But if we look at very long-term individual stock returns, we actually see that there's an incredible skew in their returns. So this is in this study, which I show here on the chart, quite interesting. You can see that if we look at the performance of US equity markets over a very long time period, they've obviously far exceeded the returns of the risk-free rate. But the reason they've exceeded the risk-free rate is down to only 4% of the total pool of stocks over this time period. The remaining 96% of stocks in aggregate just basically kept up with the risk-free rate. So it's just really interesting to see this skew in outcomes. And it's certainly the case within growth exposures that we see a skew. We tend to see a high failure rate, but those companies that succeed, that gain market share, that often, particularly in technology, benefit from network effects, tend to see very large outsized returns. And look, it's an approach to growth investing that venture capitalists use. A venture capitalist will make 100 individual bets, and they'll hope that one or two of those bets pays off, but pays off big time. That underwrites the whole venture. Their average expected outcome across each bet is that they'll lose 100% of their money. Now, obviously that's an extreme in venture capital, but the framework still is there. So the issue becomes, how do you pick those winners? And it's very hard to do so. Our view is the best way to play thematic investing is to invest in all companies that are adequately exposed to that theme in a market cap style approach, and let the market capitalization weighting within your portfolio determine how much you hold of winners and losers. So as the stock starts winning, you end up holding more of that within your portfolio, and as the stock starts losing it, it de-weights that stock within your portfolio. That is something which is actually quite a challenge. If you're an active investor, if you are picking individual winners within a theme, this dynamic, this positive skew means you're very likely to miss out on one or two winners, which can mean that you substantially underperform. And we think that that's an advantage of holding a theme in aggregate and using a passive approach over active. On this slide here, I just show the selection, and this is nearly out of date. We're launching new funds as we speak, but this is our broad suite of thematic ETFs that are available in the ASX. We have the broadest range of thematic ETFs. I show color coding here across each of the names. So for example, on the top right, you see decarbonisation. The ticker code for that is ERTH, our BetaShares Climate Change Innovators ETF. In our view, the driving megatrends are both technological innovation and climate change, indicated by the dots there. A number of new funds that Tom and I might touch on, but we're looking to cover the metaverse. Solar will be released soon. We've recently launched digital healthcare, and future of food is coming out soon. I won't go through these in all detail now. I think we should maybe have a discussion with Tom, but I just want to touch on just some interesting connections and talk about some of the structural trends behind particular themes, because it is interesting how some of these themes actually intertwine and how they connect. If we look just starting at e-commerce, we know that Singles Day in China is the world's largest online sales day. In China, we see that 1.2 billion consumers on a daily basis visit China's e-commerce sites, and they're transacting with about 5 million vendors. So it's an incredible exercise, and Alibaba alone gets 2.3 billion online orders. Now, a lot of these orders require physical fulfillment. They're physical products. So you think about within that period after the sales period, how does Alibaba manage all that data, all that processing, all that coordination? And so just an incredible exercise in terms of data and coordination. And so it's little wonder that these e-commerce companies have become really, masters of managing data, analyzing data. Companies like Amazon and Alibaba, it's little wonder they created cloud computing businesses which leverage off their own needs to manage, analyze, and store this data. I mean, Amazon was originally an online bookseller. In about the year 2000, it was fast growing, it was expanding into new markets, and it was trying to build more scalable IT infrastructure to facilitate that expansion. It started then renting out that IT infrastructure to vendors who were selling their products on Amazon.com, and they then created AWS, and that was modern cloud computing. And then so, if we look at cloud computing, today, I think if I look at a structural trend, I mean, digital data is growing at about 60% per annum. And I talked a bit about interest rates and how that can influence valuations, but there's nothing happening in markets today, inflation, anything else that's going to influence that growth in digital data. That is a one-way trend. And we know that an increasing portion of that data is being stored on the cloud because it's the most efficient place to store data. That cloud actually has a physical location that they're known as data centers. The largest is called hyperscale data centers. There's about 600 hyperscale data centers around the globe, and the largest of which cover around about half of most Australian CBDs. They're huge, and we need to build 100 of these data centers globally. So the growth in data, I don't think is going anywhere. And then you see that growth in data actually creates some opportunities. So there's opportunities for exploitation. So I talk about cybercrime here, and there's some interesting stats just in the growth of ransomware attacks. Last year, about every 14 seconds, a business became a victim of a ransomware attack. And we know that if you look at chief information officer surveys, their number one priority and their area of greatest spending increase is IT security or cybersecurity. So this is becoming something that was a discretionary spending item to a compulsory spending item for businesses, and now we know governments also are spending. And the threat of Russia has obviously added further fuel there to the requirement for cybersecurity expenditure. Other opportunities in artificial intelligence and cloud computing created that cheap, powerful computing ability, the ability to store data, organize, and analyze huge data sets that previously weren't really feasible. And that's allowed that development of artificial intelligence. And we see artificial intelligence being used in factory automation. Now, I talked before about how technology sometimes faces resistance from incumbents, but another way to, and we sort of talk about people losing their jobs to a robot or to a computer, and that obviously is something which is quite emotive. But we have a massive challenge in demographics. The working age population of the West and in China, and I show a stat there on China, is shrinking dramatically and will shrink dramatically over the next 30 years. So we need automation and AI to preserve our current standards of living. So there's massive incentives there. We also see that, for example, artificial intelligence is making huge strides in the development of autonomous vehicles, in the growth in the distance that test vehicles are traveling each year before a test driver in California, where a lot of the testing of these vehicles is occurring, needs to take over the reins. And artificial intelligence is also being used in developing fast charging technology for batteries. Batteries are about 30% of the total value of an electric vehicle, and ensuring that asset within the vehicle is protected using artificial intelligence to preserve the life of that battery while charging it as efficiently or as quickly as possible is clearly a priority. And then we can see how electric vehicles are in fact influencing the grid. So we're seeing an increase in distributed energy, people using home solar, and then the possibility of using, once electric vehicles get to a scale, there is a latent capacity for storage in electric vehicles. And there's a technology known as vehicle to grid, which is being developed. And that could be a real game changer to how we actually manage our power network. So, there are a number of, underlying mega trends or if you like, I guess, things that are coming out of these mega trends that aren't going away anytime soon. But it is important also to not just to look at that and get excited about the name of a fund. It's important to really understand what you're investing in. Look at the underlying stocks within that portfolio or the index methodology, which you should be able to find on the ETF provider's website. Get an understanding, is this really giving you pure play exposure to these companies? And ask that ETF provider, what are the stock overlaps and correlations between a particular theme and the broad market? Are you just getting like effectively a broad market tech exposure dressed up as a theme, or is this going to give you some diversification, true thematic exposure? Really, what you want to see with a theme is above market revenue growth. I think revenue growth rather than earnings growth is probably the more measurable metric that you can look for. And what I show here is the earnings growth forecast for a number of our thematic funds versus global and Australian broad market revenue growth. So typically, as Warren Buffett will tell you, we expect revenue growth around about the level of GDP growth over the long term. And we can see here that clearly the revenue growth of these themes is much higher than that. So please ask your ETF provider or ask Thom, if you're looking at a theme, ask, how true to label is this theme? I did mention this before, but I wanted to touch on an example as to using a selection of thematic ETFs within portfolio construction. So I just used that example from the graphic before of the three funds, ERTH, HACK, and DRIV. And I showed that their volatilities, and apologies, I've used an Australian ETF and Australian exposure, but this would be equivalent for a New Zealand 50 exposure or alike. But if we see here, I've got MSCI All Country World Index and the Australia 200 Index, and the volatilities are clearly generally higher for thematic exposures than broad market exposures. But what's interesting is I show here on the second table, highlighted in green, the correlations between those three themes and the global and Australian exposures. So those correlations, the lower they are, the less correlated they are. So one being 100% correlated, if you like. And we see that, in fact, they're more lowly correlated than global equities versus Australian equities. So that's kind of interesting. And then I look at, firstly, a portfolio. Portfolio A shows just a high growth investor who's got half their money globally, half in Australia, 10% in defensive Australian fixed income, and show their return and volatility outcomes. Now, what happens if we allocate just a small amount from growth assets into those three themes, so 2% in each? And so what's interesting is, there is a very, very marginal uptick on the volatility of the overall portfolio. Now, personally, I feel that, in terms of the ongoing monitoring and the like, a 2% allocation is, generally speaking, for most clients, not worth their time. And so I show here a 4% allocation across those four themes. Again, a very small uptick in volatility. In my mind, that is not really material at all, even versus the portfolio A. But what we do also see is, substantial increase, at least historically, in that total returns for such a small allocation to the portfolio. And if you see that Sharpe ratio, it's substantially increased. Now, obviously, if you increase those, the exposure to those themes further, I would expect that Sharpe ratio would increase even more substantially. But there's a balance, and we need to think about how we manage a client's portfolio with regard to their risk budget, or if you like, the volatility they're willing to accept. But this is just an example of using themes and using them and sizing them appropriately so that you're not detrimentally impacting volatility. I'll invite Thom back on. I'm not sure, Thom, can you hear me?
Yeah, thank you, Cam. I can now. Can you hear me okay?
Yes, yeah, you're coming through good.
Great. Okay, look, thanks, Cam. That was great. I mean, I think for me, the takeaway from those portfolio construction slides you just talked to are, firstly, it's really interesting to see how risk-adjusted returns can be significantly improved by just adding a relatively small allocation to thematic funds in a diversified portfolio. And flowing on from that, I mean, I really think correlation between assets is a factor that potentially we don't really take enough of a look into. And that slide you showed before really sums that up nicely, that it's not just about the overall risk or volatility of a single asset, it's how that behaves when it's combined with other assets in a portfolio. So yeah, as Cam mentioned, we do have a range of pretty exciting thematic ETFs already in the market. You can see here a selection of those. So we've talked about ERTH, HACK, and DRIV today, but we also have ETFs covering video gaming and esports, future of payments, crypto innovation, cloud computing, online retail, and e-commerce. So we really cover a significant amount of ground there. So I might just come on to just talk a little bit more about a couple of those that we've discussed this morning. So DRIV is our electric vehicles and future mobility ETF. This was launched at the end of last year, and really this aims to provide a more comprehensive exposure to the electric vehicle ecosystem. So this fund doesn't just contain EV manufacturers, but it also it includes companies that are involved in the infrastructure around the sector, so such as parts and equipment manufacturers and charging station manufacturers. It's interesting to note, there was an announcement very recently that BP, the oil company, has just announced it's investing almost 2 billion New Zealand dollars over the next 10 years in the UK to triple the number of ultra-fast charging stations that are available. So that's an old school fossil fuel company now making significant investments into EVs. In New Zealand, recent stats in New Zealand were that around 14% of all new vehicle sales in 2021 were either EV or hybrid vehicles, and that included almost 7,000 fully electric vehicles. So relatively small uptake so far, but this year so far, Tesla Model 3 is the best-selling passenger vehicle in New Zealand. So really shows uptake even at a local level. Yeah, Cam, have you got anything to add there?
No, I mean, yeah, good on you guys for leading the charge. Australia, we're a bit of a laggard. I think 2% of new vehicle sales are EVs. I don't know the proportion of hybrids. But yeah, if you look at countries like Norway, 8 out of every 10 new vehicles are electric vehicles. Obviously, there's incentives in place in foreign jurisdictions, but that's going to be the case here eventually. I mean, I guess the important point on this exposure is we spent a lot of time looking at creating the appropriate exposure, and we look globally. There's actually a number of what we consider quite badly defined attempts at providing an appropriate exposure. Like, we know that within the automotive industry, there's going to be winners and losers in this game, because it's really, we're talking about a shift from internal combustion engines to electric vehicles. And we saw a number of exposures which essentially just provided exposure to the automotive industry as a whole. So we thought it was really important to ensure that our fund, the index that we track, has targeted exposure, which is benefiting from those companies that are leading the charge in terms of manufacturing electric vehicles, but also all of the supply chain elements within the automotive industry that focus on the fact that a car's turning from a machine into a computer effectively. So companies like Aptiv, like Luminaire, like Infineon, these companies that really stand to benefit from the increased content that they'll be putting into cars, as opposed to guys that used to make spark plugs and pistons. So from our perspective, we like this exposure.
Great, thanks, Cam. Moving on to HAC. This has been probably one of our most successful thematic ETFs to date. Has a reasonably long track record already, having been launched in August 2016. But it's really generated significant interest recently, this whole space, particularly on the back of the recent Russia-Ukraine situation. Russia's estimated to be responsible for over half of all cyber attacks. And the global average cost of a cyber attack to an organization is estimated to be around $4 million US, or over $4 million US. And some of you may recall in more recent history in New Zealand that the NZX itself was the subject of a cyber attack a year or so ago. And I mean, you can read in the report and accounts, but I think probably close estimate there is that it probably cost NZX around $1 million. So these are very meaningful risks for companies now, and so HAC really aims to provide exposure to companies that are at the forefront of cybersecurity and protecting companies from those types of risks. Anything to add there, Cam?
Good point. I'd forgotten about the NZX hack last year. The most recent story that's sort of come out of Australia has been we've seen increasing hacking of people connected to house sales, because property's booming here, conveyancers, real estate agents, where hackers are effectively trying to extract housing deposits off very nervous buyers and sellers. So all sorts of organizations are being hit, and so therefore the expenditure is just increasing in this space. And this fund has performed incredibly well over a long period of time. It's I think 20% per annum since inception, versus I think Misky World would be 12% over that per annum over that period. And it's substantially performed over the last year, and in some ways no surprises given what's happening on the world stage and increasing geopolitical tensions. But certainly from an investment standpoint, has performed well off obviously a very unfortunate situation.
Yeah, thanks, Cam. And finally, just wanted to highlight ERTH, which is our climate change innovation ETF. And again, here, what we've tried to do with this exposure is provide access to global companies involved in carbon reduction. So this fund doesn't just focus on green energy. The index tracked by the fund also includes sectors like battery recycling, sustainable food, and sustainable building products. So again, Cam, I mean, this is probably an area where you're quite into the detail here. So yeah, anything you want to add there?
Yeah, look, just maybe to highlight the fact that I guess the requirement to get to net zero by 2050 and the expenditure goes far wider than just building wind farms and solar panels. That is actually only a small part of the overall expenditure McKinsey put out, and they're quite a bit of a leader in terms of this space, in terms of thought leadership. Put out a recent study at the start of this year, talking about where carbon emissions and methane emissions come from, and actually their forecast for areas of expenditure. And the highest area of expenditure they predict is mobility, which includes obviously things like vehicles, but also shipping and all modes of transport. So if we think about the requirement spending in buildings, insulation and alike, and heating and cooling, for transportation, for agriculture, which is a massive emitter of methane. It's really, a lot of this is about preventing emissions in the first place, rather than converting our power source from fossil fuel to green energy. But certainly, this will be a multi-decade, multi-trillion-dollar per annum spend. And so these companies obviously stand to benefit from that.
Great, thanks, Cam. Look, finally, as Cam alluded to earlier, we are planning to launch a number of new funds over the coming months. Just to highlight a couple, Metaverse, where we're looking at solar power ETF, the Future of Food ETF, which we already have a ticker for. That's going to be IEAT, and our forthcoming digital health ETF, which the ticker will be EDOC. So yeah, some plenty to look forward to there, and we're really trying to build out probably the most comprehensive range of thematic exposures available in the market. And just finally, just to point out, on the product side, we are planning to launch a range of New Zealand Pi funds later this year. So you'll be getting more information about those in the coming weeks. Thanks, Cam. Let me just change my slide. Here we go. So yeah, important things to consider here. I think really just to highlight that thematic funds are long-term investments, and they can be more volatile than traditional broad market exposures. But yeah, as Cam really showed, I think earlier, adding more volatility at an individual asset level is not necessarily a bad thing if that volatility is uncorrelated. And just on that point, we have a really strong analytics team here, and we can really help you, if you're interested, to analyze how thematic exposures could impact your client portfolios from both a risk and return perspective. So if you provide an existing example of your model portfolio, and we can show you how adding certain thematics into that portfolio could impact it. So do bear that in mind. And on that note, just in terms of what we provide in terms of information, please visit our website. There's loads of information there on fund data, blogs, investment information, advisor resources. We also, as hopefully all of you know, provide a significant amount in terms of regular insights. I would urge you to sign up to Bassanese Bites if you haven't already. David Bassanese is our chief economist and produces a regular weekly summary of market moves and key macro points. So do sign up for that. And obviously you can follow us through all the usual social media channels. Okay, so that really concludes the presentation. We'll open up for questions. Cam, there's a question here. Taking ERTH, your climate innovation ETF, as an example, how do you go about constructing an index for a product like that, and how's that different to the way that other managers might do it?
Yeah, okay, all right, great question. So for thematic ETFs, the approach we take is quite theme specific. Different themes lend themselves to different approaches. For the example of ERTH, the index provider is Sol Active. They're a well-known global index provider, but we've partnered with a group called iClimateEarth, who are a UK fintech. They run a number of decarbonisation ETFs, both in Europe and the US, and they're really a leader in the space of decarbonisation and identifying companies with decarbonisation solutions. They are an expert panel who analyse the products and services, or decarbonisation solutions, if you like, of companies globally, and identify companies that have greater than 50% of their revenue exposed to those solutions. So we use an expert panel, if you like, to identify the companies for that specific ETF. Those companies are then combined in a index of 100 stocks. There's individual stock caps to ensure that no stock is we're overly weighted to individual stocks, because, as I said before, we want to maintain exposure to the theme, not to individual stocks. But for that theme, the most appropriate approach that we saw was to use that expert panel, because we did look with the other index providers were sort of offering, very traditional sector approaches to green energy or alike, but just didn't see an appropriate approach there. So that's one example for ERTH, and there are others where we use different expert panels. So, for example, HAC, we partner with NASDAQ and CTA there with that level of expertise that they have. But for other themes, so for example, DRIV, while this is a emerging electric vehicles and mobilities are emerging thematic, the way that companies are classified, there is in fact very granular data that we can access through data providers that gives very granular revenue data. So for that one, we're able to break down individual revenue lines into sort of, if you like, products and services connected specifically to that shift in the automotive industry. So for that one, it's about using very bottom level revenue data. So different approaches are used for different thematics. It really, there's no one size fits all, and a lot of the work we do goes into selecting the right approach for the right fund.
Great, thanks, Cam.
Yeah.
And just finally, just a question on probably no surprise on inflation and interest rates. So how do you see rising inflation and interest rates potentially affecting these thematic type of funds?
Yeah, look, I mean, yeah, good question. So I'll take it sort of like holistically. Like, I did talk about, so let's talk about the two factors, so earnings growth and valuations. In my mind, we've seen that bond yields have risen, and that is particularly in January impacted stocks that are, you might call growth stocks. We're sort of at that part of the cycle where the Fed and now the RBA and other central banks have started raising interest rates, which often what we find is at that point in the cycle, eventually the economy starts to slow as those higher interest rates filter through and start to restrict economic activity. Now, where that's actually helpful as a growth exposure is that cyclical stocks that are very exposed to the economy, as monetary conditions tighten, their earnings starts to bite. On their earnings start to be impacted. Whereas if you're accessing a growth exposure, provided those growth markets are still growing, and that's the area to have conviction in, they're less impacted by that. And so what we really like to see here is that over the cycle, that earnings growth will continue to grow. So, I mean, I think obviously inflation has had an impact because the yield curves are steepened, and that's reduced PEs of growth stocks. And we don't know whether or not, no one can tell you whether bond yields will continue to go up or not from here. Over the short term, we don't know the outcome. But if we have conviction, and I certainly have conviction in terms of the earnings profiles, over the longer term, I think what we see is that compounding earnings growth will likely see continued strong performance from themes that continue to see higher levels of adoption.
Thanks, Cam. Yeah, I mean, I guess looking at thematics overall, whilst we can't predict the future, I think there's no question that that right now presents a much more attractive entry point to some of these thematics than might have been the case 12 months ago.
Absolutely.
Yeah. Okay, look, that's all the questions. So thank you very much, everybody, for attending. We really appreciate your time. Once again, thank you very much indeed. Enjoy the rest of your day, and I hope we'll see you soon. Thanks.